Welcome back, everyone. If you're looking for ways to generate some serious income from the tech-heavy Nasdaq 100, you've probably stumbled across two absolute giants. Today, we're putting them in the ring for a head-to-head showdown. It's JPMorgan's JEPQ versus Goldman Sachs's GPIQ. Let's get right into it. But hang on, before we dive in, we've got to get the important stuff out of the way. Just a reminder, this is all for informational and educational purposes. It is not investment advice. You should always do your own homework or chat with a financial professional. Okay, with that covered, let's get to the main event. So, we're setting this up like a classic championship bout. You know, in one corner, we have the established veteran, the big name that everyone knows. And in the other corner, we've got the scrappy, fast-rising newcomer. They're both fighting for the same title, to be your top pick for Nasdaq 100 income. But as you'll see, their fighting styles are worlds apart. Let's get to the official introductions. On the left, hailing from JPMorgan, we have JPQ, the Nasdaq Equity Premium Income ETF. And on the right, representing Goldman Sachs, we have GPIQ, the Nasdaq 100 Core Premium Income ETF. We're talking about two absolute titans of the financial world here, each bringing their own unique game plan to the table. Okay, so how do they actually make you money? To really get what makes these two ETFs tick, we've got to pop the hood and look at the engine, because this is where their core philosophies really start to branch off in different directions. And here's the fundamental difference. JEPQ is actively managed, which means there are managers behind the scenes handpicking stocks from the Nasdaq 100. Then, they use these pretty complex things called equity-linked notes, or ELNs, to generate that big income stream. Think of ELNs as a kind of custom-made derivative that's tied to the Nasdaq. Now, GPIQ's approach is different. It's more systematic. It buys at least 80% of the Nasdaq 100 and then uses a flexible or dynamic covered call strategy. This means it can adjust how much of the portfolio it's writing calls on, anywhere from 25 to 75%, depending on what the market is doing. That adaptability is really its secret weapon. All right. Enough theory, we've seen the playbooks, now let's go to the tail of the tape. How do these two actually stack up when you put their stats side by side? The numbers don't lie. So let's break this down. Right away, your eyes probably go to the yield, and yeah, JEPQ has the edge there, sitting in that juicy 10 to 11.5% range. But look closer. GPIQ is a little cheaper to own with a lower expense ratio. You can also see JEPQ is the older fund. It's been around since mid-2022, while GPIQ is the new kid on the block from late 2023. But here's the real kicker. Look at that year-to-date performance. GPIQ is ahead and by a pretty healthy margin. And this chart just hammers that point home, doesn't it? Visually, you can see that gap. So far this year, GPIQ is up around 20%, while JPIQ is up around 15%. Now, what does this tell us? It suggests that GPIQ's more flexible strategy has really paid off recently, letting it capture more of that market upside. Now, let's talk about size, because in the ETF world, size matters. JEPQ is an absolute behemoth. We're talking over $32 billion in assets under management. That means it is incredibly liquid, super easy to buy and sell, and it has a rock-solid, established presence in the market. And in comparison, GPIQ looks a lot smaller at $2.5 billion. But you have to remember, for a fund that's not even a year old, that is absolutely explosive growth. It shows that investors are jumping on board and fast. It's quickly becoming a really serious challenger. Okay, so we've looked at performance, yield, and size. But to really understand these two, you have to dig a little deeper. You have to look at the hidden trade-offs, the things that aren't always obvious on the surface. We're talking about how they handle risk, their potential for growth, and maybe, most importantly for some of you, how their distributions are taxed. And this all goes right back to their core strategies we talked about. JEPQ's approach with those ELNs basically locks in a consistent income stream. But that comes at a cost. It caps its potential for growth when the market is ripping higher. It's trading some of that upside for more stability. GPIQ, on the other hand, with its flexible call writing, is designed to let you run with the bulls a bit more. The trade-off there? When the market turns sour, it might experience slightly bigger dips. Okay, quick timeout for a very important definition because it's key to our next point. Let's talk about return of capital, or ROC. In simple terms, this is when a fund gives you a portion of your own invested money back as a distribution. The cool part, it's not taxed like income right away. Instead, it just lowers your original purchase price, which can let you put off paying taxes until you eventually sell your shares.
And this is a potential game changer, especially for anyone investing in a regular taxable brokerage account. The income you get from JEPQ is generally taxed as ordinary income in the year you get it. Simple enough. But GPIQ often classifies a chunk of its payout as that return of capital we just talked about.
So, after pulling back the curtain on their strategies, crunching the numbers, and looking at the fine print on risk and taxes, what's the verdict? Well, here's the thing. There isn't one fund that's just flat out better. The real answer is about which one is a better fit for you and what you're trying to accomplish.
So, who is JEPQ for? Simple. It's for the pure income investor. If your number one goal is getting the most consistent, predictable, and high monthly cash flow possible, this is for you. If you value that long, proven track record and the comfort that comes from its huge size and liquidity, then JEPQ's profile is pretty much tailor-made for your portfolio.
And what about GPIQ? Well, this fund tends to appeal more to the investor who wants a bit of both, growth and income. If you're looking for that healthy income stream, but you don't want to leave all the potential gains on the table when the market is hot, this could be your pick. And if you're in a taxable account where tax efficiency is a big deal, GPIQ's structure could be a major, major advantage.
And that really brings us to the final question you have to ask yourself. In your own personal quest for income, what's more appealing? Is it the veteran's proven, high-octane income machine, or is it the newcomer's modern, flexible approach that offers a blend of growth and potential tax advantages? It's a fascinating choice to think about.